1% rise in revenues for the first quarter to 40.3 billion naira, while profit after tax was up 12% to 8.7 billion naira. Standing by is the CFO of Diamond Bank, Abdulrahman Yinusa, to give us some perspective on those numbers. Abdulrahman, thank you so much for joining us on the show. I think a major takeaway for me is the growth that we're seeing in deposits. We continue to see pretty stellar performance there, 50% growth last year and now almost 10% this year. What is going on?
Well, thank you very much, Wale. We're happy to be back again. I think this is like part 2 of our discussions.
That's right.
Yes, it's just to show that the consistency in the performance of the bank has come to stay. And therefore, we're looking at a long-term growth. So if you saw 50% growth in deposit last year, and we're already into 10% in the very first quarter of the year, you can see that we're ready to post better performance in this financial year.
And this reflects your, I imagine it's your retail strategy that is driving this growth in deposits.
Yes, we've explained before that we believe that the long-term growth of the economy as a whole will depend on the retail area, because all the high net worths and the top-tier corporates, you can actually count them in terms of a finite number. The one that is ever expanding is the retail sector, where you have maybe 50 to 60 million people who are still underbanked.
Yeah, but I think something that may worry a few investors is the rise in your operating expenses, up 38% compared to the same period last year. Can you just talk us through the pressure points there?
Well, I mean, this bank is in a growth phase, so you do not grow by not spending in terms of your infrastructure, in terms of your staffing, as well as in terms of your branch network. So what we're doing is to ensure that our revenue is growing even faster than our cost of expansion is growing, which you can see, therefore, that if you look at the profit, we did a profit before tax of about 8.7, or let's just say 9 billion naira. And that is a better figure compared to the 7.5 that we did this same time last year. So in spite of the increase in cost, which is of course to expand our business, we have actually been able to do more revenue than that.
All right, I think another positive will be the decline in non-performing loans to 4.6% compared to 8% in the same period last year. Of course, last year there was some concern around the increase in provisioning. Of course, that seems to be coming down this year. Can you just talk us through how you've been able to achieve that?
Well, I mean, fundamentally, we did our cleanup in 2011, and what we've seen from that point up to now is a very gradual and consistent improvement in the quality of our loan book. So looking at NPL of 8% this same time last year, down to 4.6 now, you could see that we are definitely gradually moving the numbers. And if you look at the trend of all the NPL from the beginning of last year, which is about 10% when we started last financial year, up to now, every quarter it has been improving. And clearly at sub 5% now, we know that by the end of this year, we'll be talking about sub 4%.
All right, and how do you see the rest of the year, though? A lot of people saying these days that it's probably going to be a tough year, given where yields are in the fixed income market, even the economy. Even there are some that think the growth will be somewhat slow, and of course we are seeing some pressure in terms of oil production right now. So talk to us about your expectations for this year. Well,
I'm happy you've asked the question, and there is no year that is actually easy. Even last year, as it were, well, you can look back now and say, well, we did very well and it was good. Well, we're not resting on those achievements. We know that every year will come with its own challenges. But again, if you flip side the challenges, you also see the opportunities. I mean, for example, the issue of infrastructure financing, the oil and gas area, as well as the issue of power. I mean, with the unbundling that has happened in the power sector, the economy should be getting ready, you know, for a very significant growth in that area, and we believe that we should be able to participate. But over and above that, the idea of Diamond Bank is to continue to grow in terms of structural capacity. And once you have that in place, you then be able to accommodate whatever growth that come along the way in a very scalable form. So what we've done here is to prepare our capacity, which is why, for example, when we talk about capital raising, the idea is to ensure that we do have enough capacity into the future. And we are not looking at this year or next year. We're actually talking about the next 4 or 5 years down the line, so that we are not having to go and come back to shareholders every time to say, let's have one more capital or the other.
All right, and of course, we do know that capital raising is on the pipeline for you. But before we talk more about that, your cost-to-income ratio is now up to 60.7%. What guidance are you giving the market for where it may be by the end of the year?
Yeah, we believe that by the end of the year, we should be looking more in the 50s, maybe 55 or even below. But again, we said the bank is in a growth trajectory. And for you to be able to grow, you need to be able to spend money either to get more people to do the job or to have more branches to do your business, or for that matter, to even work on alternative channels. Maybe go online and to be able to actually have a lot of facilities in there. Now, to get all of that into the works, you need to actually spend money to get that done. But having said all of that, we still believe that by the end of the year, given the growth in revenue that we are seeing already, we believe that we should be in the 50s.
All right, so I imagine that it's going to come down because of the growth in growth in revenue as opposed to the growth in cost. Okay, now let's talk about the plans to raise capital. What more color can you give us at this stage? It's still pretty unclear how you want to approach that at this stage, but what can you tell us in terms of how you're going to approach the capital raising? And in fact, why do you need to raise capital right now?
Okay, to raise capital, I think we all know that if you're looking at any organization that is growing, one of the first criteria, is the capital capacity of the institution. And clearly, if you look at the arrangement of banks in Nigeria, clearly you will say that Diamond Bank is a tier two bank. If you are going to make a quantum leap, then you need to definitely have capacity to be able to grow. If you look at ratios, for example, capital adequacy ratio, and look at the banks generally, the average for the industry is about 23%. Some are actually up to maybe 30%. But we are doing somewhere around 16, 17%. Now, clearly, you need to show that up to be able to play fully in that. And you will recall that we also did, a lot of cleanup of the balance sheet 2 years ago. Now, when all of that has come to pass, you then need to recapitalize to be able to get yourself in a position where you can actually do the kind of business that is required. And remember, the other institutions that we're talking about who already post numbers that the industry is looking at today, on a return on equity basis, we are doing as well as any one of them. I mean, at 22, 25% return on equity that we are currently looking at now, then clearly, but of course, that is good enough.
But if you do raise equity capital, that return on equity could be under pressure. So can you give any guidance as to where return on equity will be by the end of the year? I want to get a sense of how the capital raising is going to impact current shareholders, if there will be any dilution at all.
Yeah, we still believe that even when you raise additional capital, our return on equity of about 20 to 25 will still remain, essentially because whatever capital we raise is going to be used to do business, and therefore that business will return, for itself an additional revenue that we then use to pay back to shareholders. So we believe that for this current financial year, our guidance of 20 to 25% continue to remain as something that we can do.
All right, let's talk a bit about back to the banking sector. Quite a few initiatives are driving financial inclusion, moving into the agricultural space. I want to get a sense of where Diamond Bank sits in all these new developments, largely driven by the central bank, but everybody's always talking about lending to the real sector.
Yes, I mean, from our reviews of yesterday, you recall that we grew our loan book by about 50%. I mean, that shows clearly that we're in the forefront of actually lending into the real sector. But over and above that, in the specific area of looking at the unbanked, I'm sure you know that we're also a very major player in the retail banking space, and we're also already having some interaction with some other institutions that have been licensed by the same central bank to be able to offer telephone banking as well as all the other inclusion that we're talking about. And as far as Agric is concerned, we're actually a leading institution in that respect, and we have the support of both the World Bank, the IMF, some of their funding that we're already using in that direction. But
the capital you're raising, will you be putting any of it into branch expansion by any chance? I think a lot of banks have slowed down in that respect recently.
Well, I don't want to go into specifics of one item or the other. Business growth is a function of what you need to do at any point in time. There will be issue of branch expansion. You are supposed to be in places where you are supposed to be. Nigeria is a large space, about 1 million square meters, if you recall, and therefore, in terms of number of branches that is required to cover that, our 230, 240 as we speak, may still not be able to deliver on all of that. But we're not branching for the sake of branching. It's a question of making sure our customers are able to reach us. As we speak, quite a number of them are still demanding that we get into locations not too far from them. And I'm sure you're familiar with the security issues in the country.
Right.
You wouldn't advise anybody to be carrying cash over long distances just because they want to deposit money into a bank. So all of that will happen. Now, when you have capital, you can also be able to lend more. We are going to power very soon in Nigeria, where we're going to be talking about private sector running the power sector. Now, when you do that, you also need to be able to fund some of those operations in that area. And all of us know that just the same way telecom was able to grow phenomenally in the between 2002 and now, increasing the teledensity from maybe somewhere around less than 1 million lines to about 120 million lines over a 10-year period. We think that the power sector can also do the same. Here we are talking about probably what, 4,000, 5,000 megawatts.
Okay.
Probably by another 10 years from now, 5 years from now, we should be talking about maybe 50,000 megawatts. And that we should be able to participate.